Hey, welcome back to Subject to Change, a weekly video podcast where we answer your personal finance questions. My name is Nick.
And I'm Chris, and today we are answering a question from Reddit coming to us from Sootlive. And the question is, my bank unexpectedly took out $12,000 from my account for a past car debt with them 3 years ago. I'm panicking because about 3 years ago, I was in a car accident and I had a car loan with my bank. When my insurance did not pay for the complete car after the accident. The bank said that I continued to owe them $11,500 and I needed to pay it within 30 days. I did not have the money at the time, so I could not pay it all at once, but I asked them if I could continue to pay using monthly payments, but they wouldn't allow it, and the loan disappeared from my account with them. Fast forward 2.5 years later, I've been working all year to buy a new home. I've been saving, and the bank comes in and takes the money from my account. So what do you think, Nick? Has this ever happened to you? You ever heard of something like this happening?
Just so I understand before I give an answer, this person was in a car accident, car's totaled, and they had a car loan on the car, which I think that's probably pretty common. And then they still had an outstanding balance because the insurance didn't cover. The insurance said, this is how much we're going to give you for your totaled car. And it wasn't the full amount. So they still had a car loan, basically.
So if
for a
you
car
owed, let's say you owed $20,000 on the car, but the car was only worth, to the insurance company at the time, let's say $10,000. So when you totaled the car, they're only going to give you the value for the car, not the value of your loan. So they had a $10,000, in this case, $12,000 balance.
Mm-hmm. Okay, so that's a tricky situation. I personally have never had it happen to me, but I know friends who go through similar things, get into a car accident, the car gets totaled, and then are usually surprised to find out that the value that the insurance gives for the car is 99% of the time less than how much you still owe. The insurance company doesn't care how much you paid for the car or how big the loan is. They say you're driving an 08 Civic, it's worth
this is what it's worth.
Yeah, it's worth what it's worth. So I can see how this is a tricky situation because unfortunately that loan does not go away. You can't just walk away from a loan.
Which is interesting in the question, right? Because they said, well, the loan, kind of disappeared, and they kind of forgot about it, I guess, in the 3 years, and just didn't think that. I guess they thought maybe the bank forgot about it, but clearly they hadn't.
Yeah, the bank never forgets. I feel like that's
no.
The bank never ever forgets. I do have experience with that of owing like. Last year, I owed like 31 cents on a credit card balance from a big bank that I won't name, and totally forgot about it. Well, at 31 cents, I became late. They charged me a $35 late fee, and then
a $35 late fee on 31 cents.
Yeah. It spiraled into like this $80 charge that I had to end up calling.
100,000% or something. What's the percentage on on 35 cents to $35? Like,
I'm sure it is whatever the legal maximum is. That is exactly what they charged me for.
That's crazy.
For that. So the bank never forgets. I'll say that.
The bank never forgets. Okay, so let's break this down because there's a couple of things here that I think are important from a financial perspective that our listeners are probably interested in. The first thing is that when you purchase a car, you have the opportunity either through your financial company that you purchased the car with or an outside company to get what's called gap insurance. Gap insurance purpose, and it traditionally started with leases, but you can get it on a traditional purchase and finance as well, is when the value of the vehicle, when you drive off a car, when it's a brand new car and you drive it off the lot, the value of the vehicle immediately after you buy it depreciates. Nobody wants a used car like a new car, right? A new car is a new car. No one's ever owned it before. But the minute you own it, the minute you drive it, it becomes a used car. And so it's going to depreciate in value. Whatever you paid for, it's going to be worth slightly less. And the reason why is because I don't want to buy your car for that price. I can just go and get a new one right? If the cars were the same value, I would just go get a new one and you already have yours. So in order for you to incentivize someone to buy your car, it has to depreciate in value. It has to go down in value so that your used car now has a relative value to the new car that you just bought. So that's the first thing. Gap insurance, the purpose of it is to cover the difference of the gap. Right? So, and that gap is what you owe on it. So what you continuously owe the bank on that loan versus what the insurance company is going to pay you on that used vehicle. And so if there's any gap between there, in this case, $12,000 or more specifically $11,500, they are going to cover that for you if you have gap insurance. And so if you're buying a vehicle that has high depreciation, if you're buying a vehicle where your insurance company isn't necessarily going to help you with that depreciation, you have to review your policy to see if your insurer will make up some compensation, because some will give you the benefit of the doubt, or they'll tell you the type of money they'll give you for your car if it were to be totaled. Some of them do round up, or they give you a higher value. They give you retail value in some cases, but you need to understand from your insurance company what the rule is. Then you may need to get gap insurance, and it's not relatively that expensive. Did you know that, Nick? Did you ever get gap insurance?
I have had gap insurance, and at the time I think it was in college. I didn't really understand what it was, other than talking to the insurance agent. They said the car that I was driving at the time, I think was like a hand-me-down family car, and it was, the value of it was more sentimental. Like if I crashed and totaled that thing, that's a story for another day. I would have gotten like $200 for it. Like it was completely worthless. But it's one of those things that having insurance to protect against the difference in what you owe on the car is where I was at with it.
Okay. So the second thing to take note is that when you finance a vehicle, right, and you get a loan from the bank, it's a good idea to diversify your financial institutions, because one of the reasons why they say, well, go to your own bank and you can probably get a lower interest rate. And that's true, right? Because you have a relationship with your own bank. If I go to my bank where all my money is sitting and I say, hey, I need a car loan, it's not that they don't know me from Adam. They can look up my history. They have access to my accounts because we have a working relationship. That's why they're able to extend credit to me, and oftentimes at a much lower rate than what I can get out in the open market, because they see all my accounts. They know how much money I have, and they know they have access to that money if anything were to happen. And so that's what happened in this situation. This individual financed the car note with the same place that they had their checking or savings account. And when you have money in those accounts, if you read the fine print, they can collect on delinquent payments through those accounts. So when you owe the bank money, they're going to collect, and they can collect in any way they see fit after whatever due process they go through. Now, if you had an IRA or you had some type of specialized account where they didn't have access to those funds, then they couldn't take the money from there. You can't take money out of IRA to pay for this type of for this type of debt that you have. But inside a traditional checking or a savings account, absolutely they can. And so it's important that you got to diversify your money. You don't want to put all your eggs in one basket. And in this case, it came back to bite the question asker.
I think it's something to that point. I think it's interesting. Like there is an advantage to having all your eggs in one basket, because you can build that relationship with your bank, especially if it's a local bank or a credit union. But
and sometimes get a lower credit interest rate.
And it's advantageous. You're shopping for a car, you can get a better rate because you have that relationship. But if this person actually forgot about that loan, I guess it's likely what happened in this case, because that loan and their money were all in the same bank. That loan didn't go to collections. If it was at a different bank and the bank couldn't get a hold of you at all for any reason whatsoever,
right,
you would have probably started to get collections notices in the mail saying, hey, we haven't heard from you in a while, you need to be paying this loan. And then it wouldn't have been 3 years later a surprise like this, where you just wake up one day and the bank took all of that money. I don't know if that's explicitly what happened, but I have a hunch that.
And the other thing with this is like, this is why it's important to be vigilant about your finances, right? When someone loans you money and you owe money to somebody, whether it's a collection, whether it's some other type of situation, it's important to stay on top of it. Oftentimes people get a letter in the mail from the bank, a collection agency, and they ignore it. Those things don't necessarily go away. You may not hear about them anymore, but there are statutes of limitations on how long they can collect these debts. Maybe they resold the debt. Maybe they're trying to, change the date from which it can be collected. So you need to be on top of that. So it's important to get on the phone. Don't shy away from getting on the phone, asking the questions, calling the bank up and saying, hey, I didn't have the money to pay you, but where did this go? Oh, well, we stashed that over here on this account, and we're going to collect it at some point. Like, you can now work out with something with them in order for you to be able to pay that off. And if you're not staying on top of it, then something like this can happen. And then now this individual, they're saving to buy a house. That's probably derailed for quite a bit now that they've lost these assets.
And correct me if I'm wrong, I think what could have happened if this person had stayed on top of it with that loan and dealt with it, or had known that they needed to deal with it, is they could have taken that loan amount that was outstanding and rolled it into a new loan car payment, if that's what they had to do to get a new car, to be able to keep paying that off without...
Well, it's unlikely that they could have rolled that into a new car.
Oh, okay.
Because especially when you have $10,000 or $12,000 in debt, I mean, you'd have to buy a pretty expensive car in order for the ratios to make sense. Like when you buy a car and they say, well, the loan value of the car is X, what they're telling you is that the car is worth, let's say, $20,000. The loan value that they're willing to give you is typically going to be a little bit higher than that, right? Because you have taxes, you have title, you have, different types of licensing fees. You might have a warranty or something that you end up buying. And so they're going to give you maybe 105%, 110%, 115%, maybe up to 120% of the value of the vehicle. But if it's a $20,000 car, $10,000 is a lot more than 120%, right?
That makes sense. That makes sense.
And the reason why is because the bank wants to protect themselves from this type of thing happening, right? That car is going to depreciate. And should something happen to the car, and they do every single day, cars get totaled, people get in car accidents, another customer could be in this situation, and the bank's trying to limit to their risk. They don't want a $50,000 loan on a $20,000 car. So they're trying to keep the loan value to be pretty close. But what this individual could have done is gone to their bank, since they now had a relationship where the loan was being paid off, and saying, hey, look, I can't afford to pay this vehicle off. The vehicle's been totaled. Maybe take out a personal loan to help pay for this. Or, let me continuously try to work out some type of payment plan with the bank. The bank obviously didn't just write the debt off, but at the same time, I don't think the bank wants to just take $12,000 out of your account at one time. So certainly there was some flexibility to work. And if not, there's always the ability for you to go to another bank and get a personal loan, right, to be able to pay this one off so this doesn't happen to you. But you can't just ignore the debt. You can't just forget about it. You owe the $12,000 to somebody, and you got to pay it. I
think the bank never forgets, I think, is the takeaway.
Never,
even if you don't hear from them, they remember. They know that they know you owe them money.